Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Well, welcome back, Art Jarvis. It is Taking Stock, episode number 55, and it's good to be back with you again.
Always a pleasure.
We had kind of a delay. We missed a week.
We did miss a week and a day.
Well,
or half a day.
Something like because this is late Tuesday afternoon, and we're usually at least at the beginning of the midday or late morning. Yeah. So an extra half a day, an extra half a day in a whole week. Somebody was busy last Tuesday. Maybe both of us. I'm not sure.
Life comes at you fast. I think is how they say it. Yeah.
Well, and busy seems to continue a little bit. So I'm going to say this right off the bat. I know nothing about what's going on with our economy the last few days.
So you'll believe anything I tell you then? That's fantastic.
Well, the listeners may not be as naive or uninformed or as ill-informed as I am right now. So you're going to have to be straight shooting with them. Yeah. Because we do want them to come back again in a couple of weeks.
That would be nice.
All right.
That would be very nice.
I'm going to. This is scary. This is really scary, Art. The floor is yours.
The floor. Well, where should we start? In all honesty, if we look from where we were last time we sat down and talked, we were talking about hitting 6,400 on the S&P. Let's just start with that.
All right. That's where we always start. Yeah.
Last week we were almost to 6,500, so we hit the 6,400, went right on past it. I know we hit something like 64, 67 on the S&P. And then we pulled back a little bit, especially the last couple of days. So, I think as a matter of fact, interestingly enough, this might be the first time we've actually done this and the market's already closed. So,
so you know what today did, 100%.
So we closed at 64.11 on the S&P 500, so we pulled back a little bit.
So it's still 64.
Yeah. Oh, again, I'll
not 59.
Yeah. No, definitely not. Yeah, and that's the thing. It's like I think we're in this kind of, and rightfully so. It doesn't bother me one bit. We've come a very, very long way since basically the end of April. Okay, we were at 48.50 or something like that, and here we sit today at 6,400. Yeah. So that's a long way very quickly. Okay, so I don't.
Well, so then the question, and you're going to get to continue. I told you the floor is yours, but you're going to raise questions. You're going to raise questions. Mm-hmm. So, in Art Jarvis vernacular, too far, too fast.
That's how I say it. Yeah, I think.
But is it?
Well, number one, it's August.
Okay.
Dog days, the August doldrums.
Let's say May, June, July, August.
Right.
It's only been 4 months and we've climbed 1,500 points.
Yeah, so we're up 32, 33, 34%. I actually haven't calculated it in my head, but that's quite a move. That's quite a move. But we need. I'm not against a breather. Okay, so it's August, which is, now everybody that ran off to the Hamptons and everything has come back to New York and they're starting to settle back in. The kids are back in school. The summer's basically over. In my household, when school starts, summer's over. So
that's Kim's fault.
It's 100% Kim's fault. Let's be clear about that. Sorry, hon. And on top of that, before, we had a 30-something percent move up from the bottom. And again, we came from somewhere we shouldn't have been in the first place. But we have moved up pretty substantially, and we're take away the whole drop and everything from where we started the year to where we are right now. It's already a good year. Okay? Yeah. But, there's a few things going on. That we extended the tariffs on China by another 90 days. Okay, so that kind of calmed things down a little bit. President Trump met with Putin, and he's meeting with Zelensky. But he met with Putin, but he didn't get any kind of a deal. I think kind of I'm not going to call it the smart money, but some of the money was, betting on they would walk away with at least a kind of an agreement. I think that was a
Well,
little hopeful thinking.
Well, I was going to say, despite the fact that right leading up to that meeting, in those, like, I'll even just say the final hours leading up to that meeting, when the media, whoever they are, that get to ask Trump questions, sometimes really stupid questions, but in those final hours, like, practically getting on a plane to go to Alaska and meet with Putin, despite the fact that Trump's answer was, I don't expect to have any kind of agreement from this. This is, I think he got what he was hoping. Let's get to where we can get Putin and Zelensky together. So,
and why is that a good thing? Because it takes some uncertainty out of the markets. Okay? It takes some uncertainty out of the markets. And guess what? I got a little positivity, and we're going to spend some money. We're going to drive the markets a little bit, right?
Sure.
The other thing is interest rates. He's already interviewing and looking at who he's going to replace Jerome Powell with. Come whatever that is, March or April of 2020.
I was going to say that's just months away.
So, but what does that mean? And he also just another one of the Fed governors, and I for life of me cannot remember this person's name, but just came in and is taking over from one of the old Fed governors. And this person is a little bit more of a dove, meaning leaning toward lowering interest rates. And then I'm going to step out on the ledge here and say that the person that Trump gives or appoints to the Fed chairman job is going to want lower interest rates, right? I mean, he has been screaming for lower interest rates for how many months now? So I would be very surprised if someone doesn't get an appointment. So the kind of the whisper thing going on is that here in the not too distant future we're going to be seeing some lower interest rates, and I think the market is benefiting from that. Once again, whether it should or not, I've expressed my opinion on this show in the past that, don't get me wrong, I love 3% interest rates. I'll take all the 3% money you give me, okay? But there's a downside to that. I ask people, why do you think they should lower interest rates? It's like, well, so I can get a lower mortgage, or because my kid's mortgage costs too much and things like that. It's like, I understand that. Yeah, it'd be nice if the mortgages were lower, but the problem is what's the other side of the equation? If you start pushing harder on the accelerator, all that does is make the economy start to heat up. And we've spent 2 years or so trying to beat down inflation. And then what are we going to do? We're going to pump on the gas and make inflation start to rear its ugly head again?
Well, where in the equation of the inflation and accelerating, taking a foot off the brake, and pushing down on that accelerator, where in that equation does the increased money coming in from these tariffs and helping us with the budget deficit, or whatever, spending, federal deficit. Get the right word, Chuck, federal deficit.
Right.
It helps us lower the deficit. So where in the equation does that fit? Like, maybe we can afford to accelerate a little bit, or does that not even...
Well, I think the way the tariffs are with number one, so if you look at imports and exports,
right?
Okay, so if your exports are starting to increase and your imports are starting maybe to go down, that increases your gross domestic product, which means that the economy's doing better and theoretically people are making more money and things like that. So you're already kind of pushing on the accelerator to begin with without even touching interest rates. So that would be, in my opinion, that would be on top of something that's already pointing toward a growth economy. A growthier economy? How's that? Yeah, I'm not sure I used that in econ class.
And I have to throw this in for the listeners and for you. So I just recently heard somebody out there in the world that has a voice use the word ridiculousness, and I thought, when did Art get together with me? He stole your word.
Yeah, because I don't know if you know, that's copyrighted. So,
well, he borrowed it. I'll take notes the next time he uses it, so you know who to go after.
There's actually a show called Ridiculousness.
I'm sorry.
So, if anything, I stole it from them. So.
Well, I know, you stay on top of those things because you taught me all about the sunglasses 3 weeks ago. So
Did I?
we digress.
Yes.
Yes. What are the things Because again, it was 3 weeks ago, and when we last did an edition of an episode of Taking Stock 3 weeks ago. What was coming a couple of days after that was the consumer price index. Yeah. So that happened.
Good number.
Good number.
It was actually slightly better than what they were expecting.
Very good. There was something else, and I've lost it.
Producer price index? The wholesale?
Yeah.
The wholesale number? That number came out on Thursday last week, if I remember.
And they were a little less happy.
They were a lot less happy. I mean, they were looking for it to go up like 0.3% or something like that, and it went up 0.9%. Right. So it was a surprise. Okay, now I'll go back to it's still only one number. Okay,
see.
So I'm not like, okay, oh my goodness, we've got an inflationary trend going on here, but it was the wholesale number. That's the producer's number. So the question is that number going to carry over into consumers? Are they going to be able to pass that on to consumers if they need to, right? Mm-hmm. But then the other thing is the Fed's number, the personal consumption expenditure inflation indicator, the PCE, it's still showing up okay too. So
my favorite, the PCE.
You good old PCE.
I gotta remember to say the PCE because I always try to remember what the whole thing is, but never mind.
Well, there's probably 100 acronyms that I can't figure out either. So, I've remembered a few over the last 30-something years. But.
Well, I guess aside from the obvious, so the producer's price index, I would say, how does that impact us? Well, potentially the passing along of the price to the consumer, and thus the consumer price is going to go up. And so that would be the bad side. And then the other obvious thing, but I'm going to state it anyway. The other obvious thing is, why is the producer price index going up?
Right. Great question.
Well, and to me, the obvious answer is because the cost of goods for producers is going up. But is that directly relative to all this tariff stuff?
A little bit. A lot of it. Yeah. If you look at just the one. It's a whole lot. It has a lot to do with cars, and cars are the ones that are really kind of getting the short end of the stick on this whole tariff thing. So so cars have a lot to do with it. Food prices still aren't really doing us a whole lot of favors. It's interesting to me that fuel prices. I think I paid just slightly over $3 for a gallon of gas. So it's not, I'm not paying $5 per gallon. It hasn't shot through the roof or anything.
Well, we haven't dropped down to like the $2.50, $2.60 range either per gallon.
Not yet.
Which, I'm trying to remember maybe jog your memory. So, and I'm just going to relate this to Trump because he's in office right now. It's his administration and the fuel and that part of the economy, oil prices, gas prices. It's his administration right now. When he left office the first time, kicking and screaming, as it were, but when he left, where were we? Do you recall? Because I think we were down in the low $2+.
We probably were, but you also have to remember that nobody was driving their car; everybody was staying home. People were working. It's a supply and demand thing. So if I'm not filling up my car as much, guess what?
Just stop. And you did. You stopped. You parked the car in your garage. You stopped. Let's go back to before that global pandemic. Mm-hmm. I think we'd already seen during the previous administration.
Yes,
prices had dropped. Things were going well in the oil industry.
Well,
oil and gas.
Let's be clear. Heading into, so if you're looking at 2019, you are correct. Gas would have been in the whatever it was, let's just go in the middle of the road, $2.50 range.
Right.
Okay,
yeah.
Very reasonable. Before we shot it up to $4 a gallon at times, almost $5. If you're pumping diesel, you were really hurting. But yeah, I mean, 2019, the U.S. economy, right before we hit COVID, it was firing on all cylinders. It may have been one of the best economies in my career.
Wow.
I mean, you look at gross domestic product, you looked at unemployment, you looked at inflation, you looked at corporate earnings. We were fine. We were rocking and rolling. We truly were. And that's to me, I call it the shame of the whole thing is whatever reason, whatever happened when we hit the middle of March of 2020, the world economy slammed into a wall. Really,
without question.
I talk a lot about we talk a lot about stay with the plan, but there are times where you hopefully can see things coming. .com bubble, the Great Recession in 2008, 2009. The economy was in a situation where it's like, okay, this just isn't making sense. Now, and sometimes it took a year or 2 years before we had an adjustment. So you're sitting there going, this isn't right. And finally it took 2 years for it to adjust. The problem with 2020 is it's almost like someone went into a room and just turned the world economy off one day.
Right.
You literally slammed into a wall.
Well, that's such an aberration from
it is.
Normal. But you know what? It's a good point though, because so was the mortgage crisis slash.
Well, I hope that's an aberration.
And
But let's be clear. I say this all the time. Humans have very short-term memories. So you can go back and look at everything that caused the Great Recession with the banking and the things that they were doing with loans and things like that. Guess what? That lesson was forgotten pretty quickly. Okay, there's things going on again. We're doing things. We talked about this maybe a couple of episodes ago that I can go to the store and I can finance my groceries.
Right.
I mean, what?
Don't do that.
I don't. Well, I mean, I can go on Amazon.com and say, "Oh, look, you spend $100 a day, but if you want to, you could stretch this out over 4 to 6 months."
Yeah.
Why? And okay, I bought some vitamins. I'm not financing my vitamins over a 4 to 6 month period. It's just, and the problem is you get 4 or 6 months down the road, and when you're supposed to make a payment, and you maybe don't have the money, in certain areas.
Things can happen.
So again, we've got a lot of things going on. The world's changing, artificial intelligence, and all these kinds of things that are going on. The world is changing, but we need to kind of go back and also remember the lessons that we've been taught in a very harsh manner. So
that and for people that can't see us right now because they can't.
Right.
It's audio.
That's right. There's a reason
I'm making notes, but it's remember the lessons, and that's a good reminder. We need to remember the lessons learned. Whoever we are and whatever you're doing with your investing or whatever role you play in this economy. But you touched on something again, and it keeps coming up over and over and over again, which is the AI,
right.
The artificial intelligence. Yeah. There's so much talk about it.
Yeah.
We would be remiss if we didn't talk about it in terms of investment opportunities.
Sure.
And I'm seeing things here and there, or hearing things around about the AI stocks.
Right.
And so, what do you want to share with the listeners about maybe opportunities in that AI technology stocks, or what you're seeing or hearing? What can you share with us?
Yeah, I think if you look at the chips and things like that, if you look like in NVIDIA,
right.
It's up 50% from this time last year. It took a 30-something% dip,
right.
In February and March, but here we are. Not only did it come back, it's up another 50%.
Yeah.
So you might be able to make the case.
So
in some ways, it's a little overdone, but
yeah. So you know what? That's because you made that clear just now. So they took the dip, but then they regained the base mark, and still 50% up from that.
Yeah, but you have to remember, 2023 people who owned NVIDIA made a fortune.
Yeah.
That stock, it looks like a rocket taking off in 2023, 2024. Got to be into 2023, all through 2024. So, there is a such thing as people get nervous. They had these huge profits.
Yeah.
and all of a sudden, we're worried about tariffs, and the economy's going to shut down, inflation's going to go through the roof because of tariffs. All those things that didn't materialize because of the tariffs. Well, guess what? If I'm looking, I'm scared about my portfolio. Well, I'm going to take some profits in the thing that just, take it. I always hate to say this, but it's kind of like gambling. Taking your money off the table and play with house money, right?
Right.
So yeah, there is that. But to answer your question, I think it still behooves people to focus on some more of those artificial intelligence kind of peripheral stocks. So what are the stocks that are going to help build up the artificial intelligence sector and things like that? What builds up the computers and things like that? I mean, it's funny. Someone said that the internet was a fad and it wasn't here forever. And guess what? I think it is, at least for an extended period of time. But you kind of hear the same thing. Artificial intelligence is going to integrate itself into pretty much every single part of our lives. Okay.
Well, and on that note, with that information, so it's safe for me to say, or put words in the mouth of Art Jarvis. So Jarvis Global Investments is doing the analysis of those companies that are a part of the artificial intelligence technology.
Yeah,
and maybe making recommendations, or not necessarily making recommendations, but placing your clients' money in those places that, there's room for some expected room for growth there.
Yeah, correct. But also,
because I was going to ask the simpler question that I could ask you. So, which rocket ship should we strap ourselves to?
That's beyond the scope of this conversation. So, I would recommend that you talk to your financial advisor and evaluate the appropriateness of any investment. How's that sound? There's that liability word.
Hey, for the listeners, Art did not just read that; he just said
that's right. Yeah,
because I know it sounded like the disclaimer.
I may have heard that a few times too.
Yeah,
but y'all, that is important,
right?
Like, what is the appropriateness of some of these investments? For this person, it might be completely appropriate, and you might want to take a rather substantial position. This person here, you might want to take a less of a position and just kind of participate, and then this person over here. NVIDIA drops 30% in 2 months. Well, guess what? That's not an appropriate investment for this person over here, per se.
Right.
So, you asked, you said something about artificial intelligence and the financial sector. So of course I look at it. Okay, what's artificial intelligence impact going to be on my industry and things like that? It's interesting to me. Artificial intelligence. At least in my brain at this moment, it's going to make certain things easier and quicker, but at the same time, there's still going to be that relationship part of investing. Okay, so if 5 different people like Art Jarvis walk into a financial firm and they're all 60 years old and they all have this amount of risk aversion and they have this much debt and they have this much in assets, and they're going to retire in this certain number of years and things like that, all 5 of us are going to be completely different individuals. Well, guess what? All 5 of us should have 5 different portfolios, right? So that's the part with artificial intelligence that you're going to, and I'm not saying we're not going to get to that point. We're probably already heading to it a little bit, but there's still the relationship part of things. Okay, I had people call me all day long about what about this and I need this and things like that. Well, guess what? Artificial intelligence isn't at this moment in time isn't going to take care of that, right?
Right.
So yeah, it's down the road. In my opinion, but it's, you just talk about, just kind of like all the things in your house that have computer chips, now. Well, somewhere down the road, artificial intelligence is going to start to integrate itself into your life. Okay, whether it's coming from your TV or your phone or your car or your appliances or whatever listening device is in your house at the time, something probably we don't even know about at this moment in time. So. Yeah, that's a very long-winded way, but it's also important. That's artificial intelligence is the buzz phrase right?
Yeah.
Anything at all, it's kind of like the .com, right? Anything.
Well, that's exactly.
Comology.
That's the point.
Yeah. You got to find who's the one that's actually going to be able to take technology. Who's going to come up with a business model where they can actually make some money? Okay. Who's that company going to be? Who's the company that's actually going to be able to insert themselves in there and come up with a way that not only are we going to come up with all these nifty little things, but we're actually going to be able to make some money off of it? There's the question. So.
Well, then that's the rocket you want to get on.
That's 100%. But you know how I feel about rockets. I would much rather have a stable of several rockets. Okay, and have as opposed to
Well, because the one that misfires, you don't want that to be all it's the eggs in a basket.
That's exactly what it is.
You gotta have multiple baskets.
Yeah, I mean, I can't. I found in my career that I think I do a really good job on the asset allocation and the global allocation. The actually picking the specific company that I think is going to be the winner. Okay, that's a lot tougher. So if I go buy the technology instead of buying a couple of technology companies, I go and buy the whole technology sector because I like the sector. I end up doing pretty well. It cuts down on the volatility. My analysis and everything is more of an aggregate analysis, and I have found, at least for me, it's worked out pretty well.
Yeah.
So.
Well, and as we come to the final closing couple of minutes,
that was fast.
Yeah, that brings us all the way back to where we started, which was the S&P 500, which is where that's the asset allocation. If you're an S&P 500, S&P 500 has some AI technology stocks in there, but you're not totally dependent. Like Nvidia's in there,
Well, it's in there a lot.
Yeah, so but that's the point. Yeah. So that's the whole idea. That brings us all the way back full circle to where we started, which was the S&P 500. Yeah. I always like to close. It seems like most recently, anyway, with so what's coming up. We're gonna do this again in 2 weeks. Mm-hmm. We're not gonna wait 3 weeks.
Okay, good.
But I believe it's going to be 2 weeks in a day because 2 weeks is the day after Labor Day. So, and we're going to need to rest that day.
Yes, a day of rest. Yeah.
Sure. But anyway, for some reason or another, we already have a full slate on September 2nd. So we'll be back September 3rd. Yeah. So what are the things are between now and September 3rd? Strain your brain for a second. What's coming up in the numbers world?
I don't think there's any, impetus to really make things rock and roll unless all of a sudden we get some kind of Ukraine deal or something like that, or a tariff with, a conclusion or something with China. But I think, I'll say it again, I like the little cooling off period, number one. That allows a couple things. We're still getting corporate earnings for the second quarter, right?
That comes in.
Well, they've been coming in for weeks, but like this week is retail numbers.
Okay.
So we're getting a lot of retail numbers and things. So that allows some time to pass, and with time passing, you start moving forward on the calendar and into your future earnings numbers, okay?
Yeah.
And, as long as we don't mess with interest rates or anything, theoretically, the S&P 500 should be worth more 2 weeks from now than what it is today. Okay, so
and we closed at 64.11.
64.11.
Okay.
So yeah, with my normal caveat, as long as nobody does anything stupid. But yeah, I'll stop there. But no, it's
as long as there's no ridiculousness.
And there's always going to be ridiculousness. Yeah. One of the first things I do when I get up in the morning is probably the second thing I do is I pick up the phone and look and see what went on while I was asleep, right?
Isn't that, and that's so funny. The world we live in today, it's like pick up the phone and look to see what's on. We used to pick up the phone and call and ask somebody or something. I don't know.
Different world.
What the heck is a phone today anyway?
And I used to walk down to the end of the driveway and pick up my newspaper,
You had that Wall Street Journal on
the
your
Wall
driveway.
Street Journal was delivered to the driveway,
Excellent,
and then you go into work and they had 2 or 3 papers, so you read it. But guess what? that was all old news by the time I got it.
Now it's on any one of those monitors that's like I'm pointing at that people can't see. Here's a monitor. It's called my telephone. There's a monitor because I do have a desktop in Studio A here at the Loveland Beacon headquarters. Anyway.
You are literally, I receive information all day long.
Yeah.
You know, and some people in my house will get a little upset because my phone might be pinging or dinging or clinking or whatever. So I got to make sure I get it turned off before I go to sleep. But all night long, there's news coming across, sports,
love it,
internet. Yeah, it's good stuff.
All right. Well, we'll have to throw some of that sports talk into the next one in 2 weeks. We'll be like on the edge of the kickoff of the NFL football season. Here in Cincinnati, we'll call it the Bengals season.
All right.
Yeah. Well, Art.
Go Bengals and Lions.
Thank you.
Yeah.
Go Bengals.
I'm definitely go Bengals.
And I'm also, go Lions. That's that Detroit native speaking.
I am not against the Lions.
Right now, it's still baseball season. I'm still go Tigers.
Mm-hmm.
And there's this there's this thread of hope for our Cincinnati Reds. And we won't talk about Crazy Legs and the Red Stockings, hitting 900. We won't talk about that. But
no, not at all. No, I won't say a word.
I just threw that out there for fun. Anybody wants to question it, go for it. By the way, we will be at Florence Y'all's this Thursday night.
Is that right? Thursday night?
Absolutely. Actually, it's Thursday afternoon, 5 p.m. But anyway,
you have something going on. You have something going on in Miami Township somewhere too, don't you?
September 20th.
That's the 20th. I went by and saw the sign.
Yes, sir.
Yeah, so that's good.
All right. Well, Art Jarvis thus concludes episode number 55 of Taking Stock. Thank you so much for being with us today.
Thanks for your time. It's always a pleasure.
Mine too. Thanks very much. Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.